Welcome to Analyzing and Recording Economic Events Related to Inventory, Part 2. The economic events that we'll consider in this module are selling inventory to the customer, offering the customer a discount, incurring a charge for shipping to the customer, and finally receiving payments from the customer. Starting with selling inventory to the customer. Our example, during June of 2000 of year 1, Acme Fireworks sold 700 bundles of fireworks to its customers. The sales price for each bundle is $10, and the total shipping cost for all the fireworks is $200. To encourage faster payments, Acme offers customers payment terms of $210 net 30. The payment terms were defined in the previous module. If you're not familiar, you may want to go back and review. So if we sold the fireworks to the customers, two things are happening. First, revenue is earned and the customer promises to pay later, with revenue being the price that's charged for providing the good or service. So revenue increases, which means net income increases and equity increases. The other side of that is that the customer is promising to pay later, so our assets increase. So we're increasing accounts receivable and increasing sales revenue by the selling price of the fireworks. The other thing that's happening is that inventory is going down and the cost of inventory, which is an expense, is going up. It's easy to understand why inventory, the asset, is going down because we're taking our inventory and sending it to a customer, so we don't have that asset anymore. The other side of it, the expense, is increasing, may be a little more challenging to understand. What's happening here is recall that an expense is the cost of providing a good or service. We had to pay for the fireworks when we purchased them in order to have the fireworks to sell to our customer. So the cost of the fireworks to us represents an expense. The expense goes up, net income goes down, and equity goes down. In addition, as we said before, inventory is going down because we're sending the inventory to the customer. The journal entry to record that transaction is to debit cost of goods sold, which is an expense account, and credit inventory. This journal entry will be for the cost of the inventory to us, but we'll look at determining the dollar values in a little more detail in the next couple of slides. First, measurement of accounts receivable and sales revenue. We know that we sold 700 bundles and each bundle we sold for $10. So that gets us to a selling price of $7,000. We're also offering early payment discount of $140. So if we use the net method, that means we'll subtract the $140 from our $7,000 selling price, which gets us to $6,860 in sales revenue. So our journal entry for this transaction would be to debit accounts receivable for $6,860 and credit sales revenue for $6,860. If you'll notice, we did not record the shipping charge with this transaction. We'll take a look at the shipping charge in just a second. The other thing I want to point out is that we could have also recorded this transaction for the gross amount, which is $7,000, and we'll do that near the end of this module. The next thing we need to look at is the dollar value for recording cost of goods sold and lowering inventory. This is not based on selling price, but based on the cost of the inventory when we purchased it. If you recall from the previous module, the cost of each bundle is 2.998 cents. So the cost of the fireworks that we sold 700 bundles. 700 times 2.998 is equal to $2,099. So our journal entry to record the cost of goods sold and to lower our inventory will be for $2,099. The cost of the inventory to us when we purchased it. The next thing we'll look at are shipping charges. When we paid for shipping to get inventory to us, we increase the cost of inventory. However, when we pay for shipping charges to get the inventory from us to the customer, we're going to debit shipping expense and credit accounts payable for the shipping charges that we incur. That's $200 in this example. So we're debiting shipping expenses and crediting accounts payable for $200. To review our ledger related to inventory, we purchased 1,000 units. We returned 200 units, which left us with 800 units available for sale. We have 700 units left. We sold 700 units, which means we have 100 units left in inventory. So the 700 units we sold, cost us $2,099. The 100 units that we have left in inventory cost us $300. So to double check, 100 times 2.998 cents per unit is approximately equal to $300. Remember, we're rounding to the nearest dollar in this example. So if we receive a payment from customer, that's what we need to study next. Recall that we recorded an accounts receivable of $6,860 when we made the sale. That was the net amount if the customer takes advantage of the discount. If payment is received within 10 days, that is the amount that the customer will pay, $6,860. So we'll debit cash $6,860 and credit accounts receivable for the same amount. However, if the customer pays after 10 days, the customer will pay the full price without the discount, which is $7,000. That means we'll increase cash by $7,000 and decrease accounts receivable by only $6,860. Since the customer paid us more than we originally put into sales revenue, we're going to increase our sales revenue by $140 because the customer is paying us an amount equal to more than what we originally had increased sales revenue by. So if we think back to our earlier entry, we increased sales revenue by $6,860. If the customer pays us $7,000, we get to increase our revenue by $140. But what if the gross method is used? If the gross method is used, we would have recorded accounts receivable and sales revenue for the full amount, not the amount after the discount. That means that accounts receivable would be increased by $7,000 and sales revenue would be increased by $7,000. If the customer pays within 10 days, the customer will only pay $6,860. This means that we will need a debit of $140, which we will debit sales discounts for that amount. Sales discounts is a contra revenue account, which means it's going to lower our net reported revenue. Alternatively, if the customer's payment is received after 10 days, the customer will pay $7,000. So we debit cash $7,000 and we credit accounts receivable $7,000. In this case, we don't need to adjust our sales revenue because the customer is paying the same amount that we increased sales revenue by. So in review, if we sell inventory to a customer, 2 entries are required. One to lower inventory and increase cost of goods sold based on our cost of the inventory. The other is to increase accounts receivable and increase sales revenue, and this entry is based on our selling price. If we give a discount to the customer, it lowers the selling price, but does not change the cost of goods sold. If we incur a charge for shipping to the customer, that shipping charge goes to expense. When we receive payment from the customer, we will increase revenue if the discount is not taken and the net method is used. If we receive payment, we will decrease the revenue if the discount is taken and the gross method is used to record the sale. So that wraps up our second module for recording economic events related to inventory. We just have a couple things to wrap up with in our final module.